Venice started as an accidental geography, a cluster of muddy islands in a shallow lagoon at the northern edge of the Adriatic Sea. It lacked fertile land, mineral wealth, and natural army routes. However, it had water, isolation, and access. These limitations compelled Venice to find different solutions to problems. Those solutions changed how money, credit, trust, and power could work without a territorial empire. Venice didn't conquer the world with armies. It financed it. From the start, Venetian survival hinged on trade. Salt, timber, fish, slaves, spices, grain, everything needed to come and go by sea. This led to an early focus on logistics, contracts, and risk management. While land-based kingdoms depended on tribute and taxes, Venice relied on movement. Goods had to flow, payments had to settle, and trust had to extend beyond personal relationships. By the 10th century, Venetian merchants were already trading throughout the Mediterranean: Constantinople, Alexandria, Antioch, and Tunis. Each journey was costly, slow, and risky. Ships could sink, pirates could attack, and wars could close ports overnight. A merchant sending cargo abroad needed money up front and assurance on the other end. This pressure led to one of Venice's earliest financial innovations: shared risk. Rather than having one merchant fund a voyage, Venetian contracts split ownership of ships and cargo into shares. Losses were shared and profits were combined. These arrangements, early forms of joint stock ventures, reduced individual risk and expanded overall trade. Money became more than just stored wealth. It turned into coordinated trust. As trade grew, coinage became an issue. The Mediterranean was flooded with different currencies: Byzantine, Salidi, Islamic dinars, and Carolingian deniers, each differing in weight and purity. Merchants spent time weighing, clipping, testing, and negotiating exchange rates. This friction slowed down trade. Venice tackled this by minting its own reliable coin. In 1284, Venice introduced the gold ducat. Its design changed little for over 500 years. It was consistent in gold content and nearly universally accepted. The ducat became a symbol of trust. When someone accepted a Venetian ducat, they acknowledged Venice's assurance that the coin was worth what it claimed. This was serious, not just symbolic. Venice enforced strict regulations on its mint. Counterfeiting faced harsh penalties. The state recognized that monetary credibility equated to geopolitical power. Each ducat circulating abroad spread Venetian influence without the need for soldiers. However, coins alone could not suffice. Large-scale trade needed large-scale settlement. Transporting chests of gold across seas was inefficient and dangerous. Venice addressed this by converting deposits into transferable claims. By the late medieval period, Venetian banks accepted coin deposits and issued written credits. Merchants could transfer balances through ledger entries instead of through physical exchanges. Money began to exist as accounting. Value moved faster than metal. This change was subtle yet revolutionary. Once money existed primarily as numbers in books, controlling the books meant controlling the economy. Venice did not let private banking evolve chaotically. Banking was viewed as a public function linked to state stability. When private banks collapsed during crises in the 14th century, Venice learned from it. In 1587, the Republic established the Banco de la Piazza de Rialto, a public bank. This bank did not lend or speculate. It existed solely to clear payments. Merchants deposited coins, and transactions were settled through book transfers. The bank became a trusted neutral ledger. Disputes dwindled, settlement speed increased, and trade volume grew. Later, in 1619, Venice created the Banco del Giro, which went further by allowing overdrafts backed by collateral. This effectively introduced credit money within a managed system. Venice institutionalized credit without fully privatizing it. The essential point is this: Venice separated money from metal earlier and more cautiously than most states, yet it never allowed money creation to escape political control. Banking served commerce, commerce served the state, and the state maintained stability. Venetian governance supported this system. The Republic was not democratic by today's standards, but it was highly bureaucratic and less corrupt than many medieval systems. Financial positions were rotated, records were audited, and power was distributed among councils. No single family could dominate banking for too long. This approach mattered because finance is fragile. Trust disappears more quickly than it builds. Venice understood that credibility was its primary asset. If trust was lost, the entire system would collapse. Venice also standardized contracts. Notarial systems recorded debts, partnerships, insurance policies, and wills, creating legally enforceable records. This led to predictable outcomes, which lowered risk premiums. Reduced risk fostered more trade. Marine insurance emerged as a formal product. A merchant could insure a voyage against loss for a known cost. This turned uncertainty into a manageable price. Once risk could be priced, it became easier to handle and scale. By the 15th century, Venice operated more like a clearinghouse than a city-state. Goods flowed in and out, and payments were settled through Venetian banks. Credit originated in Venice and spread outward. Other cities traded with one another using Venice's financial infrastructure. This is how Venice became a bank. Even warfare became financialized. Venice rarely relied on feudal levies and instead hired mercenaries. Wars were budgeted, and debt was used to fund campaigns, with taxes servicing obligations. The Republic treated war as an expense, not as a holy crusade. This approach reduced unpredictability, but introduced long-term debt. Venice issued government bonds known as prestiti. Citizens were required to lend to the state in exchange for interest. These bonds were transferable, leading to a secondary market where people traded state debt. This created a new type of financial asset, public debt as an investment. Venice essentially invented the sovereign bond market long before modern nation-states. Its debt tools were regarded as safe because Venice consistently honored them. Default was unthinkable. The consequences would be reputational ruin. By tying citizens' wealth to state stability, Venice aligned incentives. The elite wanted the Republic to remain stable, as instability would risk their investments. This alignment allowed Venice to maintain debt levels that would have overwhelmed less credible states. However, it also led to inequality, concentrating wealth among those with capital to invest in bonds and trade. Venice was not a utopia, it was efficient. As global trade changed in the 16th century, Venice faced competition. Portuguese routes bypassed the Mediterranean. Atlantic powers emerged. Silver from the Americas flooded Europe, leading to inflation. Venice adapted gradually. Still, its financial structure left a lasting impact. Amsterdam, London, and later New York borrowed heavily from the Venetian model, creating public banks, clearing systems, and sovereign debt markets. Stable currency was backed by credibility rather than just metal. The idea that a city could act as a financial platform rather than a territorial empire was revolutionary. Venice proved that standardized and trusted money could replace conquest. However, this also unveiled a darker reality. Once finance takes over, power becomes abstract. Decision-making shifts from visible leaders to invisible ledgers. Those who grasp the system gain an advantage over those who don't. Venice's decline was gradual, not sudden. Bureaucracy became rigid, innovation slowed down, and financial conservatism upheld stability but stifled growth. Ultimately, Napoleon dismantled the Republic in 1797 with little resistance. Yet the Venetian model persisted beyond its political fall. Modern banking systems still reflect its core principles: public debt markets, centralized clearing, credit as accounting, and trust as currency. Venice showed that money isn't just a way to exchange goods. It acts as a system of control, coordination, and belief. When a society agrees on whose numbers matter, it empowers whoever keeps those records. Venice didn't become a bank by chance. It shaped itself into one because it had no alternative. Geography pushed for abstraction, trade demanded
Trust and survival called for innovation. The outcome was a city that financed empires, facilitated commerce, and demonstrated that financial structures can outlast political control. The Venetian money empire was not built solely on gold. It was constructed on rules, records, restraint, and reputation. That blend remains the bedrock of every modern financial